Okay, so as I said, I'm Steve Miller sitting in for Peter Davies of Jigsaw Trading. Today we are happy to host Merritt Black's second SMB Capital presentation to our Jigsaw members. Merritt's topic today is called Essential Skills of Great Traders. If you have questions during the webinar, please access the Q&A function and type those in there. We will wait until the end and then I will read those out to Merritt one by one. But please type them in as they come to mind. Essential skills of great traders. Many want to be traders, but simply aren't aware of what is preventing them from becoming one. Merritt Black, head of futures for SMB Capital in New York, will be sharing the main skills necessary to join that select group of traders that make it and thrive. SMB Capital is one of the top prop desks in the world for developing aspiring traders into real high performers. Welcome, Merritt, and thanks for joining us.
Thanks for having me, Steve. It's good to be back. Always I think it's a great blend of audiences when we get my crew together with your crew because we're kind of focused on structure, higher time frame thesis of various ways of identifying really great risk reward and what the market's doing each day. And then we combine that with your crew who obviously the way you guys train them and whatnot have great order flow skills. And I just think the pairing of those two worlds is where the magic happens, which is why the last talk I gave was on context plus order flow. So looking forward to diving in today. So thanks for that. All right, guys. So almost any time I get on and do a talk, it is my genuine hope that I bring something fresh to you. It's my genuine hope that this webinar is not like the other 25 webinars you've already listened to that talk about essential skills of great traders. I hope we really have some light bulb moments. If I don't think I can deliver some light bulb moments, then I don't do the talk. But let's dive into it. We're not a broker-dealer. Trading futures is extremely risky. Everything we're talking about here today is for educational purposes only. So real quick, before we dive in, most of you probably heard already, but SMB Capital's been around a long time. We have a long quality track record in the stock trading space. I've been tasked with building out a futures desk for SMB Capital. We have a very unique hiring process. You could be anywhere in the world. You can trade for us remotely. You just show us in a simulated environment that you've got what it takes, meet some very minimum standards of ours, and then you become a part of our team. You get access to myself. You get access to some of the top psychologists in the world. You get access to all the training and anything that I have that the public would need to pay for. You get access to all of it. You're a part of our team. Why would I charge you for something like that? It's time for us to invest in you if you're able to join our team. So again, it's a very, very serious opportunity from anywhere in the world. It's not something where we're interested in you making, let's say, $5,000 a month. That's not a win for us. We're looking to develop, just like we do and have done on the equities desk. The numbers will scare you, okay? We're actually, a lot of people, they tell you the absolute best thing they could about their firm or what they've got going on. We don't even really tell how good it is because the numbers would absolutely, possibly scare people away or maybe even attract people for the wrong reasons. But just believe me, the opportunity is huge. We start you small. Don't get it mistaken there. We start you small, but the opportunity to grow and get big is exactly what we want, and the potential's there today. So listen to me today. Make your own judgments about the things that I'm about, the things that SMB Futures is about. And if it resonates with you, if you feel connected to what we're about and what we're doing and the things that I'm teaching here today, you want to be a bigger part of it, then let's connect, okay? So, great traders, it's not entirely about skill, but skill's a huge thing. We certainly believe in talent being overrated, having to put your hours in, being process driven, all these kind of things that some people, sure, you could be more cut out for it. I always tell people that I was the worst person in the world cut out to be a CPT. Just very, a lot of issues that I had to work through to get where I'm at. Obviously, you have to manage risk, right? We're not gonna talk about that today. You're not gonna hear from me today. The number one skill of a great trader is to manage their risk effectively. Yeah, thanks, Merritt. Remember what I was saying, that this is supposed to go beyond some of the stuff you've heard from the other 20 webinars. So I hope it's a fresh perspective, and let's get into it. Skill, right quick. It's the ability to do something well. A particular ability. A skill is a particular ability. A lot of times we like to look at something we don't understand. Guys that watch me trade live, watch recordings of that. Guys that watch a pro athlete on Sunday Night Football. And we just say they've got ridiculous skill, right? And often we kind of just lump that into something we don't quite understand, and it's this intangible thing. It's skill. I'm sure they were born with it. They're a freak athlete, right? We think that's very, very wrong way to view that across athletics and across trading. We think that you need to determine what the skills are that are necessary for you to do what it is that you want to accomplish. You need to be able to decipher where you currently stand, and then you need to be able to develop the particular abilities that you need to become more of a well-rounded, holistic, rock-solid trader. Okay, so my talk today is not going to fix all this for you. You should know that. What might fix it for you would be not typing in the chat asking what platform you should use right now. Maybe that would be a place to start. Let's focus on the skills required to be a great trader. And let's spend this time together really locked in and focused on this particular topic. Essential skills. That's me working with a guy that we had on the desk, now what I would consider a good friend of mine. And we're locked in on what were you doing today? What are skills that we can improve to help you do better? That's what our mentoring and training programs are all about. So number one, operate within uncertainty. The ability to, the skill of operating within an environment of uncertainty. I think there's a reason. We're going to go through 10 main skills, and I threw this together in somewhat of a logical progression, at least in my mind. So this stuff is going to kind of build on it. It's going to kind of do some things. And it's almost like a prerequisite type stuff, although it's not a perfect case. But this one would certainly fit that bill. And we're going to refer back to this one even as we talk about some other skills going forward. If you cannot operate within an environment of uncertainty, if you cannot let go of outcome, if you cannot work on belief systems, which ultimately this is what it that you need to develop, that allow you to operate effectively within this environment, you will forever be plagued by all of the 20 list of common trading errors, right? How many of you have been on those webinars? Top 10 trading errors, right? Well, I genuinely believe that this number one skill right off the bat here is the answer to many, if not most normal, common trading woes, okay? So it's all about beliefs. I'm of the Mark Douglas trading in the zone religion, if you will, okay? We all come into trading with certain belief systems, things that have shaped us throughout our lives, things that have allowed us to, quote unquote, be successful in various aspects of careers and relationships and whatnot. And to be successful in trading is counterintuitive. In order to be a great trader, we have to develop new belief systems. And for me, they really do come down to randomness and uncertainty and getting very, very comfortable with that. Truly understanding the nature of markets and just how much things are outside of our control and how few things are inside our control. How do you adopt these new belief systems? It's something that's come up quite frequently lately. So some of you that are in our Slack room and whatnot and been on our Futures Fridays webinars have heard me talk about this lately. And it's, you don't change a belief system overnight. The best way I know how to put it is that there's energy attached to current belief systems, and it takes time, focused effort over sustained periods of time to put energy into a new belief system. Okay? On one hand, you thought you could predict what's going to happen next. On the other hand, you learn that you can't actually predict what's going to happen next with any amount of certainty. All that we're doing as traders is more like what a casino's doing. Do you think a casino tries to predict the next spin of the roulette wheel, the next turn of the card at the blackjack table? Think of it. All these people are betting against the casino. Do you think the casino tries to figure out what the next card is, what the next spin of the wheel is? No, that's futile. So it's easy for us to understand that from a casino model where we understand, oh, they have a slight edge in their favor. The probabilities will play out over time. They create the rules of how much you can bet, how much you can win, how much you can lose, which AKA is risk reward. They structure the game. As traders, we structure the game. We're the casino. We create the rules, and we go get our sample sizes. So I talk very much in depth about this stuff in my intro course, SMBFutures.com. You can dive into the beliefs and psychology section of that intro course. Skill number 2, you got to act for the right reasons. You have to take action for the right things, for the right reasons. And to me, that comes down to motivations. Believe me, guys, believe me. The biggest mistakes I've made in trading have typically come down to when my motivations for putting on a trade are out of line with the right reasons for trading. We all know what the right reasons for trading should be, right? It's because you have an occurrence of your edge that you've clearly defined and you put on the trade. All the boxes are checked. It's time to trade. You don't put on a trade because your last 3 trades were losers and now you're trying to make it back. You don't put on a trade because you crushed the morning session. Now you get cocky in the afternoon and you want to crush it even more. Those are all motivations for trading, for taking actions. So in order to do this, you've really got to redefine what it means to win on a day-to-day basis. Winning is not a positive P&L at the end of the day. Winning as a trader is not a positive P&L at the end of the day. That is not the goal. That should not be the motivation. Otherwise, You're going to do things to sometimes hopelessly and carelessly try and get, like I used to do, that P&L positive. So we need to create structure, checks and balances, rules, processes, ways of going about doing things within an environment of here's what my goal is. Here's how I'm defining winning today. And that's how you really get to acting for the right reasons. You got to be able to do it. Got to be able to do it. Number 3, you've got to have the skill of seeing things based on a truth-based market worldview. That's a mouthful right there, right? It's one thing, a truth-based market worldview. What the heck is that? A worldview, that's quite simple, right? That's how you see the world. You grew up in a certain environment with parents that taught you certain things. You know, obviously there's cases where you rebel against the type that your parents are and things like that. I think more common is the apple doesn't fall far from the tree. You end up seeing more of that, right? You know, I never had a choice of being a big Bama fan, football fan. I never had a choice of being an Auburn fan, right? My parents were diehard Alabama fans. So my worldview was that the Crimson Tide is good and War Eagle is bad. I never had a choice in the matter. This is the way things are. These are the way worldviews get shaped and whatnot. So as a trader, you need the uncommon truth-based market worldview, the way things are. Trading's all about risk reward. I believe there's a random distribution of outcomes of trades. The next trade that I put on, I don't know if it's going to be a winner or a loser. I don't care if it's going to be a winner or a loser. The thing that I'm most focused on is finding a trade location that gives me really good risk reward, because I know that over time, I'm around a 50-50 trader. It's a coin flip whether my idea is right or not. But I make more when I'm right than I lose when I'm wrong. So that gives me a positive expectancy. How do I do that consistently? That's because I have a grounded in truth, the way things work in the markets, based view of risk reward at any given time. For me, it's derived from auction market theory principles and market profile. It could be volume profile. I have a couple of reasons why I prefer market profile. This gives me a directional bias, as well as where that line in the sand for that directional bias would change. It gives me an ideal area for entries. Doesn't mean that my ultimate entries have to be from that particular area, but I know that that's the ideal risk reward for entries. And I would love to do business there if I can. If order flow doesn't offer that, if we just break away from there quickly, then I'll go with what is. I'll do what I can within the context of the final point here. My market worldview allows me to see potential destinations where the market is likely to go to relieve the pressure, to complete an auction cycle. You can learn everything that I know about this stuff in the market profile course I have at smbfutures.com. I'm not trying to go through and just plug my courses here, guys. We're done plugging the courses. That's the second one I have in here. That's the second course I have. It's just that I genuinely believe that these things that I'm teaching and putting out in the world are really good. Okay, I'm trying to build a desk of high-performing traders, and I genuinely believe in this stuff. And so I'm putting it out into the world, and I hope nothing more than people can take it and go to the next level and join our team and all that kind of stuff. So you got to have a truth-based market worldview. Let me say a little more about this. I don't believe that the man-made things are truth-based, okay? So if it's moving averages, if it's, Elliott waves, if it's Fibonacci retracements or extensions or these kind of things, believe this, guys. If you don't believe me, go try it out for yourself. Put a random line on the chart. Put a couple random lines on the chart. You will see that they work. And, oh, well, you see, we got through this line, so it kept going. It was a significant area. Oh, look, we kind of head faked above that one, and then we turned away from it. Absolutely. That type of stuff is going to show up all over the place with random lines. Now, do I think that fib retracements are better than random lines? Maybe. Maybe there's some self-fulfilling prophecy type stuff in there. Sure. But it's not good enough. It's not good enough. You have to have more of a market-generated, truth-based market worldview. You got to be able to see these things that I point out in these points that we just talked about. You got to be able to see objectively. It doesn't matter how good your market worldview is if you can't see objectively. You have to be able to stay in the moment. You have to move from where most traders are, which is thinking it's a game of predicting. You want to predict less. You also have to let go of the past. You have to let go of the past. You can't let the outcome, typically it's recency bias stuff. You can't let the outcome of, oh, well, this trade didn't work the last 2 times I tried it. Guys, go study math. Go study statistics. Take a look at the random, plug it into Excel or some of the free tools online. If you have a great trading edge, let's call it 50-50, 2-to-1. You're right half the time. You make twice as much when you're right as when you lose. What do you think's normal? If you take over 1,000 trade sample size, what do you think is normal in terms of losses that you could sustain in a row? And let's not even say normal, expected for it to happen. It's a lot. It's a big number, guys. It's more than 2 losses in a row. I promise you that. So letting go of the past within the framework, let's go back here to number 1, the belief systems around randomness, uncertainty. Maybe we could add around the statistics of just trading with an edge and what that looks like. A great edge and what that looks like. So let go of the past. Another thing is you may have made a mistake. It may not be just about whether or not your past couple trades were winners or losers. You may have made an error. And the thing that you have to do, what we call a mental 2-step. 1 is you admit the negative. Admit it. Don't put it under the rug. Don't pretend it's not there. Also, don't tell yourself that you're never going to be able to do anything right, that you're a real piece of crap. Just admit it from a neutral perspective. Jot it down in your journal. And then the second part here is the next shot is more important than the last mistake. The next trade is more important than the last mistake. You got to move on from it. You got to let go of the past. This stuff is less about you and more about the market. I see too many mental snowflakes. You got to build some mental toughness. You've got to work on those belief systems that we talked about in number 1. And you've got to just realize the randomness that we're dealing with and stop getting so attached to individual outcomes of trades, because over the long run, it's meaningless. Anyways, you got to be able to see objectively. So stay in the moment, which is a generic phrase. I'm going to talk more about it. Predict less. Trade what is was the theme of my last talk with you guys. Let go of the past. This is less about you, more about the market. While you need to predict less, so the second point here and the last point, Those seem like they're opposing each other, right? You're telling me to predict less, but also visualize future scenarios, which is like predicting, isn't it? Not quite. There's a subtle variation. There's a subtle difference between these things. So we're not making predictions as to what will happen. We're not making predictions as to what even should happen necessarily. But we can visualize what if this happens, what if that happens. And that's it. So it doesn't actually lock you into kind of, the age-old example of you fight a trend day all day because you're locked into thinking the market's overextended and it's due for a bounce. So you're sitting there buying it all day and all it's doing is nothing but a downtrend. So it's not that. You visualize future scenarios, just like in the morning. I know many of you are familiar with what we teach, what a lot of people out there teach, which is coming up with some scenarios, or hypos, short for hypotheses, as we call them. This doesn't lock you into not being objective. It's actually the opposite. It actually makes you more flexible, and it makes you prepared to act quicker. If you've already thought through some of the if-then scenarios, you're actually able to stay more objective about what is occurring. Otherwise, you get a little too caught up in perhaps your last trade sequence. You think it should go down, so you're trying to short. You haven't prepared for it. What if it goes above a certain level, that's all of a sudden a bullish scenario. You're more likely to be less flexible and actually continue to fight what we call a shift in the market condition, a context change, things like that me and my guys talk about. You got to be able to quickly adapt to those. See objectively, and then the skill set around using time frames. There's many different things related to this. One is you need to find a time frame that fits you, your lifestyle, your availability, your level of commitment, all these kind of things. And I'm not really going to go into that. And here's the big one. Here's the big one to me in terms of time frame. You can't do it all. I just see too many people that say, yep, I look at a monthly chart, a weekly chart, a daily chart, a 240-minute chart, a 319-minute chart, a 60-minute, a 30-minute, a 15-minute, a 5-minute, a 2-minute, a 133-tick chart, and a 17-tick Rinko bar chart. That's what I look at, man. Okay, nice, man. That's a lot of chart. My next question for you is, what are the job descriptions for each of those charts? What do each of those do for you? And then you hear crickets. You really, to get a quality three-dimensional view of a market, you really need roughly 3 time frames. Really and truly. You need a higher time frame to be able to frame context. For me, that's like market profile. You need a trading time frame to identify, let's call it, whether we're trending or range bound or things like that on what we call the trading time frame. And then a lower time frame can be great. Bring in some order flow tools. That could be your lower time frame. But each of those need to have very specific job descriptions across those time frames and know what you're using them for. You simply can't look at all time frames and try and trade ideas across all those time frames. You end up making serious blunders in terms of trying to express one time frame pattern that's developing or whatever on another time frame, and that doesn't work. It's more complicated than that. And the funny thing is a more simplistic view is what frees you up to do the right things and do a better job. Skill number 6, know your edge. Really and truly know your edge. What variables need to be present to give you an instance of a positive expectancy in the market at this moment in time? Within that, within the core variables that must be there, what layers of discretion are acceptable for you and your process and your trade plan and your methodology? How much discretion are you going to allow yourself? It's complicated. You could have a fully discretionary read on, let's say, one of the variables. For example, in order for you to get long, you could say the trend must be up on my trading time frame. That's fine. You certainly don't want to use the wrong time frame for that variable there. Doesn't make sense to make sure the higher time frame is up. Doesn't make sense to make sure the lower time frame is up. You're probably going to be out of cycle there if you're doing it on the lower time frame, and the higher time frame doesn't matter as much. If you're in a particular trend which filters, okay, I'm long only, I don't care how discretionary that read is for that variable. Variable one is identifying the trend on the trading time frame. If it's up, I'm going long only during that mode. That's great. Your read as to what is an uptrend or downtrend can be as discretionary as you like. I don't care. Okay? It could be very discretionary, but it needs to be rule-based. You can't avoid defining the intraday trend on your trading time frame and therefore that filtering whether you go long or short or neither. Okay, so rule-based discretionary is really the way to go for at least people in our world of intraday trading. Even swing traders and things like that, I would argue it's very, very helpful. So you got to know the variables. You got to know how much discretion you're allowing yourself. And what I really mean by that is not what I just said, although it's just a different point. The point here of what layers of discretion are acceptable, that means if you've got the higher time frame thesis, it's perfect. You've got the intraday setup and trend, it's perfect. Great. Now when it comes to order flow, does order flow have to be perfect? Does order flow just have to simply not tell me that this is a terrible idea right now? How much discretion are you going to allow yourself when it comes down to the order flow and the actual pulling the trigger? Things like that. You need to plan in advance for those. Be okay with the level of discretion you're giving yourself with. It can evolve over time. But then allow yourself to be wrong. It's discretionary. Learn from it. Continue to document the decisions you're making based on what variables with that discretionary component and see if there's ways to get better. That's all part of doing a quality review process and monitoring your statistics and things like that. Number 7, rank and distill. Distill, what are we making some bourbon here? What are we doing? No, we're ranking multiple pieces of data within a hierarchy of importance. This is critical, guys. For the type of trading that I do and that I teach my students and all this stuff, this is critical. Are we at the overnight low? But, we're also considering VWAP. We're also waiting that there's a poor low on the profile yesterday below us. What's the relative volume like today? What's the contextual order flow piece looking like? What's the intraday trend? How do you weight all those different variables within a hierarchy of importance to make quality, repeatable decisions? Extremely important. A skill that you must have. And then beyond that, you've got to distill down complexity into information that's meaningful to your methodology, relevant to the situation at hand and whatnot, and usable. I see a lot of people post what for me is garbage in our Slack room, and they say, well, we've got an OPEC meeting here, or the Saudis said this, or things like that, and that's not usable information in my world. How are you going to make a trade off saying, well, the Saudis said this? Is that a trade for you? I don't think so. I mean, you may have ways of factoring in fundamentals into your trading, and I'm not going to necessarily poo-poo on everybody that's doing that. But for the most part, is that going to help you see risk reward? Is that going to help you get into a trade? What's the entry for that? What's the, that type of stuff. Number 8, you have to have the skill of timing rotations. We all know timing is critical for traders. It's all about timing, right? What does timing actually do for us? It improves both sides of risk, both theoretical risk and actualized risk. So I really love the way, what's his name? Neto, I believe is his name. He came to New York. He knows Mike, and he was talking to us one day. He's got a book, and he's saying, I have this new way of calculating risk-adjusted returns. And I like what he does. He takes theoretical risk. These aren't his terms. These are just my terms. I forget the terms he uses. But theoretical risk is I'm getting long here, and my stop is down here. My size is this. So I'm risking this much on the trade. That's theoretical. You may never lose that much on the trade. It's just theoretical. And then actualized risk is what we refer to as MAE, max adverse excursion. The most unrealized P&L losses that you had during the trade. Let's say it didn't go in your favor immediately, so it traded down 5 cents against you before going in your favor. Well, you took 5 cents of actualized risk on that trade. So the better your timing is, the less theoretical risk you have to take, and the less actualized risk that you will end up taking over time. This is very important that you separate this from any other component of your trading. It's its own unique model, which is layered inside the risk-reward market worldview model. It's layered inside an overarching risk management model that dictates everything. Various models that we have to run as traders, whether or not you've thought to compartmentalize those like that or not. I think it's very important to compartmentalize your execution model, which is all about timing and whatnot. One thing that can help with developing this skill is understanding the market you're trading, its tendencies, its rhythm. Rhythm is kind of a thing that we really start out talking about with group mentoring classes and things like that. Identifying rhythm, plot a zigzag indicator on the chart to help you see that rhythm and not be too micro, seeing every little up-down fluctuation, see the bigger kind of picture, the ebbs and flows. And it's all about, in terms of timing rotations, it's applying shorter term measurements such as your read on momentum, order flow tools, things like that to help you time rotations better. A lot of benefits of doing so. You've got to be able to apply tactics. We could expand that and say apply appropriate tactics. But most people don't even have a toolkit of various tactics that they can reach into to vary what they're doing based on things. I mean, you wouldn't believe how often I see an ES trader tell me they trade with a 2-point stop, and they trade with a 2-point stop during the summer when the average daily range over the past 20 days is 10 handles a day. They're trading with a 2-point stop. And then, we go into an environment where the average daily range is 60 handles and they're trading with a 2-point stop. That's not really applying tactics. So it's within an overall strategy and within an overall goal of what you're trying to accomplish as a trader. Markets are not as simple as we would like them to be. As I mentioned, volatility changes, the speed of the tape changes, momentum, whether it's present or not, changes, whether moves are what we call clean or messy and very overlapping, how much liquidity or volume is present, are we doing during rollover periods or not? These things call for various tactics to apply based on the conditions that you're seeing. Having a great market worldview is a big help. A big help identifying where we are relative to recent structure and what's going on. It can really help you. Everything from big opportunity, regular opportunity, absolutely no opportunity type understandings, to even tactics of, I think of a student I'm working with right now where we both traded that we did a one-on-one call and we both traded the same session together. And the thesis was there, the setup was there. We were both taking the same trades essentially. I came out ahead and this trader came out down. And the difference was my read on order flow at the time. I knew that order flow was not being supportive of what we were doing. So the tactic I applied was to be way more, what's the word here? Way more active in my trade management. I was really scaling out of positions pretty quick. I was really scratching out of positions quite quick instead of giving them full stops and looking for normal larger rotations into larger time frame targets. I wasn't doing that. I applied different tactics based on the fact that I didn't have order flow really in my favor at that time. Got to be able to have this skill. Number 10, last but not least, you've got to have the skill of being a self-coach. You've got to be able to self-coach. Everyone that I work with, that's the goal. I think the big goal is to have them trade our money and trade for our team and be a part of that. But another big goal of when I'm coaching someone and working with them is to transfer knowledge and information, to monitor them, to show me that they're exhibiting understanding and prowess, and then teach them to learn to develop on their own via various feedback loops and whatnot. Towards the tail end of when I'm working with someone, I literally tell them, you don't need me anymore. You don't need me anymore. And that's a beautiful thing. Just read any Dr. Steenbarger book to get better about being a self-coach. Certainly, the Daily Trading Coach is a go-to resource for that, but all of his books involve a lot of components around that, including his blog. In order to, some things that involve being a good self-coach are judging your decisions based on actual information at hand, not what the outcome was, guys. Judge your decisions based on the information and the variables according to your process at which you made the decision. Whether it's a decision you made or some form of indecision that you didn't. Don't base it on what happened next with the market. Base it on real information that's repeatable and relevant for you. Stay fair with yourself, okay? Stay balanced in terms of negative and positive feedback to yourself. I was the world's worst early on of just doing nothing but being negative on myself. You can't just fix weaknesses as a trader. You got to build from strengths as well. One of the big parts, that kind of feedback loop that I alluded to in the first point there, is understanding your own performance metrics, how to read them, what to look for, and then how to implement proper tweaks based on the information given to you from those metrics. Real quick, a bonus, you got to be able to do what you say. Set a goal that's entirely within your control, not just a goal, okay? Not a P&L goal, something that's actually within your control. We try and do this daily around here, daily process goals. Actually focus on it. Redefine what winning means to you that day based on this process goal. Actually get better at it, which is impossible not to if you're motivated and really working on it as a priority. Number 1, embrace uncertainty. 2, Act for the right reasons. 3, have a truth-based market worldview. 4, see objectively. 5, understand timeframes. 6, know your edge. 7, rank and distill. 8, time rotations. 9, apply tactics. 10, self-coach. And the bonus there, do what you say. Thank you so much for putting your faith in us to help move your trading forward. You can join our community. We have a Slack room. You can train with us, aka identify and develop skills. And finally, you can join our team. You can trade on our team remotely from anywhere in the world. Just check out smbfutures.com. Hope this has been helpful to you guys in even if in some small way.
Yeah, that was excellent, Merritt. Thank you very much. Shall we just go through some of the comments as well as questions over here that we've got?
Sure.
Okay. First, I want to just comment and say, yes, we really enjoy Dr. Steenbarger. He also presents here, and we always get a big crowd for him because everyone really, really enjoys his discussions about self-coaching and such. Tonight, we have attendees from as far away as Germany and India, so thank you all for attending. Let's talk about one of the comments from Phil R. Pro traders simply react to what the market is doing rather than basing a trade off a bias born of expectation. Hence, the reason a trader should always anticipate but never expect. It's a lot of words.
It's not a question. He's just giving.
It's just an observation, really, right?
Absolutely, man. Trading is more about reacting, although I think he puts it just a different way there towards the end. But absolutely preparing for scenarios and then reacting. Yep.
And MK makes another note like that. He says, let yourself be wrong. It's okay. Trade small and play the game, was his observation. Okay, and then Simon Collard, he talks about news for me is a heads up that a trade I'm in can get upset by the news if it's relevant news, that is. Okay, so it can actually be a reason to exit.
Yeah, typically if it's very relevant news, it's going to take care of the exit for you. Yeah.
Okay, and okay, so we have some more questions piling in here. Just a moment. Let me move through those. Do you have or intend to have a Treasuries Futures desk?
We have no one at the moment who is solely focused on treasuries, but certainly one of our goals as a desk is to diversify our pool of traders across various asset classes, if you will. And so that's certainly something that we're interested in for sure.
Okay, and I guess I should say who that question came from, Robert Espinoza. Thank you, Robert. Let's also look at a question from Ron C. He's basically saying, how much interaction do you have with those trying to make the trading desk?
The people trying out, not so much. That's just unsustainable. I'm one person with limited time to do maybe half of what needs to be done every day, and my time goes towards people that have made it through that HR phase and are a part of our team, as well as all the actual students that I have and things like that. So that's pretty much zero interaction other than in the Slack room. We have ongoing conversations, people posting different things. I comment on different things, just within the overall community, general stuff. But there's not a mentoring component for everyone trying out for our desk. It's just our HR process. That's how you get through the hoop to get the attention.
And we have a question from Corey Francis. How does Merritt use order flow when making decisions? He mentioned order flow, but didn't go much into what he was seeing.
Yeah, that's just not the topic of the talk today. We could do a 6-part series on how Merritt uses order flow. We just don't have time for that today. I'll give you the short answer, which is I am most interested in not. I don't really like to look at a dome and look at people threatening to trade, as in what orders are where. I'm much more interested in orders that are actually transacting, which Peter and I have discussed in the past, and he wholeheartedly agrees that that's certainly the more relevant information. So just all kinds of tools, whether it's looking at the delta, volume into the asks and the bids, using a footprint chart to see that, all that kind of stuff. Or, your basic tools for that is what I use.
Okay, and here's a question from Noble Joe. How do you measure or know if the corrective move will not turn out to be an impulsive move after forming your hypos using market profile, price action concepts?
I would argue that the specific language of that question is trying to predict. How do you know if XYZ will turn out to be XYZ again, something else? Okay? We don't. So we simply look for what we call acceptance, movement across key lines in the sand, which are substantial enough to change our opinion on what the current market condition is, whether that's going from a range-bound market to a trending market or vice versa and whatnot. We don't try and get that far ahead of ourselves. We can plan for that, just like was in the talk. We can plan for it and have it as a scenario that may happen. And if it does, we're ready for it. But until then, we trade what is.
Toby Owens is asking, any tips on learning the rhythm of the market?
Yeah, pretty much the best thing that I've found is what I said earlier, putting on a properly sized zigzag indicator onto a chart. And what it does is it starts to cut through the noise. There's a lot of little bitty up and down squiggles all over the place. But take a look at more of those fractal swing high to swing low to swing high to swing low type moves and get a sense for what that is in your market. And it's going to evolve over time. But knowing what it is most recently as you come into a potential trade decision, it's going to help you be more in tune and improve that timing.
Dade Howell asks, how do you tailor order flow reading to an appropriate time frame that matches your trading time frame and move potential, aka filter out short-term noise in order flow?
That's tough. I'm going to give you my gut reaction here, which is you can't. I think order flow, by definition, is the most granular view of a market you can possibly have. So it's always going to be dropping down to that microscopic level or time frame. That's where order flow happens. Now, could you look at various volume tools or different things on higher time frames? I suppose you could. I would argue that they may not be as meaningful on those higher time frames. That order flow, it's very much attached to, by definition, to that lowest time frame.
Mm-hmm. Francis, I hope I'm pronouncing these names close to correctly. Francis Butcher is asking, do you trade on order book or, do you trade on order book with Jigsaw Day Trader?
I do not.
But you like the Day Trader tool. I know we've talked a lot about that before.
Oh yeah, it's a great tool. It's just not something that I've adopted. In fact, it's only something that I've recently ever pulled up and taken a look at. It's just not something I've made a switch to.
And then Lee Griscom is asking, are your futures traders focused on a single market like crude oil, or do they trade multiple markets, DAX, NASDAQ, etc.?
Varies from person to person.
Okay, Tony Arado is asking, based upon market conditions, do you uh, do you do you try? I think it's try different markets at the same time, such as crude and ES and NYM.
I do. Um, I would say 90% of what I end up doing is in crude, just because it does typically offer some of the better daily ranges, some of the better momentum on a more consistent basis than other markets, in my opinion. But absolutely, when crude's dead as a doornail, and let's say over the past couple months, the equity indices have really come into play. The volatility really picked up, and there were a couple days where crude was quiet, and I was totally focused on the Nasdaq, actually trading some Nasdaq. So yes.
Yeah, Chris Witchard is asking, hey Merritt, how important is understanding the market player, our participants, to read the traces, the left in the chart?
I think a different approach there than a lot of what you will hear taught by, let's say, other auction market theory people or market profile, volume profile people. I don't really buy, the importance of identifying what participant is in control. I used to be along those lines of thought, but now I've just gone to an even more simplistic worldview, if you will. Obviously, bigger players step in when significant technical breaks occur. Okay, that's just it's more of a nature of time frames. If we're trading inside the range of the past 3 days and there's not much happening and there's no news catalyst that's hitting to cause larger players to get involved, then sure, you've got shorter term players that are kind of dominating the market. And I do think that you see some things such as, one ticking the overnight high or low and little things like that. And you can say, okay, yep, looks like shorter term players are in control here, but it's almost just like redundant. If this happens, then you know that shorter term players are in control, versus if it crashes through it on 5 times average volume, hey, there's probably some big boys involved here. You don't know anything that helps you beforehand, really, other than, well, if you're not going to get outside the overnight range and volume's pretty light, you probably want to apply certain tactics. You want to call it short-term players in control? Go ahead. That's fine. But it's all kind of the same stuff.
Lee Griscom also has another question here. What type of volume do your traders average? 5 round turns daily, 30 round turns daily, 100 round turns daily?
Without getting into size and whatnot, just in terms of round trips of just flat-to-flat trades, most people fall more into that 5 to 10 range. I think it's pretty common for. We're certainly not taking 30 to 100 trades a day. No one that has joined our junior trading desk is trading that frequently.
Francis Boucher makes a nice comment here. This is what I'm trading. He says, this is what I'm training on right now on Day Trader himself. Let's go on to Dade Howell. Do you back adjust crude or use spot only?
And this will have to be the last question I take. I do have to step off. I absolutely back adjust. In fact, every chart that I have, I do a continuous back adjusted volume based rollover. That's specifically what I use.
Okay, thank you very much for your talk today and for answering all these questions. For those of you whose questions did not get answered, please don't hesitate to email into us, and we'll forward those on and get some answers for you as well if you like. But what an excellent webinar. Thank you very much, Merritt, for your time today.
Thanks for having me, brother. We'll see y'all next time.
Okay, we'll talk soon. Bye for now.